Hello, everybody. We are just going to get started here. Let some new other attendees join the call here, and give it another 30 seconds or so. Okay, people are piling in now. We'll get started in about 30 seconds. All right, well, let's get started here. Welcome to the July 2025 webinar. Today, we're going to have a really good discussion here today. I am Scott Ebeling. I'm head of energy strategy and client solutions. I'm from our broadcast studio out here in, well, this time in North Carolina. And Allie's out in Dallas today. And she is joining us, manager of pricing and strategic solutions. She was out last month. She was attending a conference. So we had on Benji and Benji Kumar, our kind of head of the company here, and also somebody from AppDirect. We're really excited here. We're having our fully in about 2 months now with AppDirect. A lot of exciting things going on and discuss, and we'll be talking about that here in a few minutes. So today we're going to talk about Box and AppDirect and a big conference thing that they host every year at really special offer they're giving to all of our consultants. And we're going to have a market update, and then we're going to go talking about what new energy policies mean for buyers. And there's a lot of stuff that's come down the pike in that in the last couple of weeks. We went over kind of some stuff right after the election, and now we're going to kind of dive into a little bit more with some of the stuff that has been passed and is brewing right now. So with that, let's dive right into about Box. Go take it away, Ellie.
Awesome, thank you, Scott. So just to take a minute to introduce ourselves, for those of you who don't work with Box yet, or maybe just need a little refresher, Box is your ultimate commercial energy brokering partner. We provide independent energy brokers and affiliates with access to all top electricity and natural gas suppliers, instant pricing, and cutting-edge software, all supported by industry experts. Box has become the largest network of energy agents, brokers, and consulting firms in North America. So all of us benefit from a variety of diverse energy partners within our network. All of us benefit from streamlined, efficient options in deregulated gas and electricity markets. And you can see those markets nationwide and how you can scale your footprint if maybe you're only operating in Pennsylvania or only operating in Texas, only sold gas in Georgia before, but you're interested in getting into power. We can help you with all of that. So you'll see natural gas markets available in green, natural gas and power markets available in blue, and then you'll see a healthy portion of the Midwest and the West, and actually north, as far east as North Carolina, where we actually do have some natural gas options. Those are limited territories where we may be able to source a supplier for a large commercial, industrial, manufacturing natural gas deal. All of the lower 48 is deregulated, I mean, nationally as far as natural gas is concerned. So if your customer is big enough, they may be able to tap into a pipe. We may be able to get gas to them. If you have some of those types of opportunities, don't hesitate to let us know. We have an awesome team of account managers and account management associates. Our affiliate team are all here to help with any opportunities that you have. That's really all what we're here to do is to help and to give you some more options, more capabilities, more solutions that you can bring your customers. And talking about more, on our next slide, we'll see our supplier network. So if you're looking to add some suppliers to your portfolio, whether you're missing some big names like Constellation, NG, Champion, those guys that have been around, TXU, guys who have been in the space for forever, or whether you're looking for somebody that's a little bit more nimble, maybe a little bit newer, more specialized, somebody who's able to offer, a really sophisticated solution. We work with these guys all the time. We have pre-negotiated contracts with a lot of them, which is another benefit of working with our team. But regardless of where your customer is located, if they are able to shop, they can shop with Box. We have a huge supplier network. We're great friends with all of these guys. All of our executives have industry background and have maintained these relationships for almost 20 years. So we're happy to put them to work for you. Another big benefit of working with Box is access to our strategic solutions team headed up by Scott and myself. We are your competitive edge in energy consulting. So regardless of whether you need a more tailored sales strategy, if you're looking for a reverse auction, if you're looking for just a little bit more oomph for your conversation, our goal, Box's goal, but specifically the strategic solutions team's goal, is to make you look like a rock star in front of your customer. So you have the relationship, and regardless of what that customer is doing, whether they're a large customer, a small customer, whether they're, regardless of the industry that they're in, if they're in manufacturing or commercial real estate, if you guys are looking for a solution, looking to impress your customer, wanting to put something in front of them that shows them now is the time to move, we can help you. Regardless of what customer it is, we're always available to help. We're happy to get on the phone with the customer or just do a prep call with you if you'd like to sound really smart. But we're here to support you guys. And any of these benefits is available with no extra cost. Just call your account manager and say, hey, I want to talk with the strategic solutions team. I've got an opportunity and I don't know the next best step. I'd like some help. I'd like some support. We are absolutely here for it. And finally, the big piece, as you guys know, Broker Online Exchange was recently acquired by AppDirect. These guys are awesome. We've actually had a ton of fun working with them over the last few weeks, getting everything integrated, everything just sneak peek behind the scenes. It's all going really, really well, you guys. So we're really excited. We are so excited to bring our brokers and to join the Thrive 25 conference happening in Austin. It's going to be August 25th through 27th. It's super cool. Go check out the website. Go check out the QR code. You have a free ticket that is, I think it's almost $1,000 value, if not more, just depending on how you use it and which sessions you attend. So this is a great opportunity to get a little bit more involved. You'll be able to come see Broker Online Exchange. We'll have a booth. I think several of our team members will be there, but then come meet everybody else. Come meet some fellow advisors who are also in the independent sales, into independent sales. Come meet with fellow entrepreneurs down in Austin. It's going to be an awesome time for everybody who's looking to grow their network and get to see a little bit more about the growth strategy that Box and AppDirect are coming up with together. So super exciting stuff. We really hope to see you there. If you haven't signed up, again, we're giving everybody, all of our advisors, you can attend for free. So come see what's about and come see us. It'd be great to see you guys in person. And with that, I will pass it back over to Scott for our market update. I know we've got some things happening.
Yeah, thanks, Allie. Again, I just want to emphasize on this Thrive 25. This is a free ticket for you guys. This is $1,000 value, right? So all you need to do is come down and spend really 2 days there, and you can learn a ton, and it's all about leverage, right? Information you're going to learn, and even if you pick up one new product that you want to kind of pitch to your customers out of it, and you learn about that, it is well worth the time and leveraging that time to be down there. Yes, I'll be manning the booth, so you'll get the I'll get the pleasure to meet you guys. I know Benji will be down there as well. So we are really looking forward to this, really emphasize to come down here. There's going to be some really cool keynote speakers. One of them is going to be Sean White, who, yes, he's X Games champ, Olympic gold medalist, but he's also a really good businessman. A lot of people think he's just a skateboarder. No, he's an incredible business person. He's going to be intertwining all that experience into that, and there's some other notable people as well, and it can really, it's an incredible conference. I attended it last year. it was in Chicago, and it was probably one of the better conferences I've ever attended. So I was really blown away by it. So we can't emphasize enough to come down there and join us and attend down there. So with that, I'll take it away here at the market update here. And we're going to kick it right out. PGM capacity. This is just announced yesterday around 4 o'clock Eastern, 3 o'clock Central, and yeah, 329.17. Surprise, surprise, huh? Yeah, hit the ceiling. We pretty much knew it would be. In fact, there was a sensitivity analysis that was done, taking away the price caps, and it would have cleared at 388. That's for the PGM RTO. There's some zones that have cleared even higher than that, but all the zones cleared at 329. Pretty much a 20% increase for every zone. This is capacity beginning in May of June of 26. So starting next year, we already have this big increase here at 329 for June of 2025 to 270. So 20% increase. BG&E, about half of that, because their prices are a little higher. Dominion, actually their prices are going to come down. So from that level, because all the zones hit 329 because that's where the cap was at. So we have one more year of this cap and floor. If we continue the cap and floor, I imagine it's going to go higher. But yeah, this is going to translate about $3 to $5 increase over current capacity costs. This is just, we put out some communication yesterday on this. Your account executives should be getting this out to you guys here shortly. We're going to have a blog post on this on our website probably today. This is essential information. It's in the news already, cycle today. People will get filtering out during the week. It's best to hear it from you as a consultant first. Communication equals trust. I say it all the time. So be the first to communicate it. Even though it's not the greatest news, they need to hear it. And that's what customers want. They want to hear this news. And again, we also really highly recommend the capacity pass-through product. Continue with that if you can. There's a lot of games that go on with different suppliers where they price capacity and where they don't. Who knows where it is? There's going to be adjustments, continue to be adjustments on this, because a lot of suppliers price it at the floor or in between or at last year's levels, and not necessarily at the ceiling. No one really priced it there, but here we are. So you're going to have this this going on. So with that, let's get to the next slide. Any questions you have on that? We can do specific analysis on this as well for a customer. Just get involved with the pricing desk, and we'll do a specific analysis of how much increase in pricing we expect for that next year. So energy price update, and these prices are down even more from here. This is up to last Friday. We had some big weekly change, big monthly changes, and as prices have kind of faded out here a little bit, especially with gas prices, and all these prices are relatively in line with the movements we've had in gas. We always look at it like in a PGM, for instance, Mid-Atlantic, that's a solid delta of about for every 10 cents movement in gas is about a 60-70 cent movement in power. So we're pretty much there in all the areas. So the heat rates really haven't changed all that much. So going into historicals here, we're going to flip through these slides pretty quickly here. This is gas, and again we've come down a little bit more here. We really look at this $4 area as kind of the price that producers really are putting out there that really they need to have to produce, where they can make money, make it worthwhile. So with that, we've put out a piece about 2 months ago calling 350 is the new floor, and versus was 250 a few years back, but 350 is kind of that new floor. We expect, yes, there's some heat this week going on. But we're looking at this is the last kind of warmish week of the year, not last warmish week of the year. The warmest week historically of the year is the last week of July, and then prices come down. I mean, weather temperature should come off. As long as not a big heat waves coming in, we think pricing will continue to come off for a little bit. We could potentially hit that 350 floor for 2026, which one in the black there, and we see 27, 28, 29 even lower. We see these as screaming buys right now with the way the fundamentals are in gas. So great time to go out and buy. One of the things that we're seeing out here, and we'll go through our charts here in a second here. Here's PGM. See prices are a little bit elevated here. You look at 26, 27, or 27, 28, pretty much even with 27. Now let's just go back to gas here. I just want to put this chart out here. Okay, again, look at that. Okay, look at the prices are lower. So that means the heat rate's lower in those years. Again, here, I'm going to tell you this because it's been pretty similar on the other charts. What's going on here is that for hedge funds now, this buying power and speculators is the hot space, right? So they bought the power, they're long power in these outer years. And one of the ways they do that to cover the risk is they buy the heat rate. So they're buying the power, they're selling the gas. So one's higher, one's suppressed, but if that heat rate comes in, you're gonna get a tap on the shoulder. Hey, you got to pull back from this trade. You're losing money. Your value at risk is going up. So this is why we expect this to kind of like come in a little bit. Where I think gas in those outer years could come up a little higher, and power could come down in this next wave of kind of middle ground weather and high load injections. And as we near, like, we're going to potentially get to 4 TCF in gas storage, taking winter off the table next year as a danger area. So that's our prediction there. So West Hub historical monthly prices. We've had some pretty good numbers here in June and July, that's why we think these prices are relatively fair in 2026 compared to where gas is at right now. Relatively fair. We do expect them to come down with gas here a little bit, but that's there are. Same thing with historical New England power. Again, you'll see 27, 28 being much lower in 26. Here's the index prices, healthy July pricing here. Texas power prices, their 26 is higher, 27, 28 a little bit lower. We think the prices here are way overpriced on the heat rate level. We're seeing some really great growth fundamental or grid fundamentals going on here. And if you look at this index price chart here, I mean, it's like there's barely getting out of the 30s any of these months. And we're having a very, very, relatively mild summer here in Texas. Yes, temperatures could warm up, but the grid is just knocking it out of the park on what they're doing. And anybody who says we don't need renewables, look at Texas. Texas has at times 50% of their load is renewable. They got a great mix right now when they built this out. Rick Perry, former governor, helped build out and get started on the Panhandle. Big renewable push, wind, solar, and it's taken over to kind of a lot of the state, and then the batteries, and it's all really come together well for them and added some great stability to the grid. I mean, there's nothing over $50 in the last 2 years here, except for that August 23, and that goes out the board. This 3-year average is going to probably drop down into the 30s. Yet pricing is up here in the mid 50s, and we're not too far from the highs. So we expect this to kind of come off a little bit. So look at this now, natural gas storage, have been really had some big injections, almost a record level, 100 plus injections, one of the largest injections we've had in the season, up to a few weeks ago. Still continuing on that trajectory. We think they're definitely going to probably be right around, in weather normal situations, right around these levels here, which is the 5-year highs. Remember, we can only store about 4.1 TCF, 4.2 TCF of gas in storage. That's going to have to increase. That's something that not people don't realize. That's a different story, a different day. Natural gas rig count. Funny, I haven't looked at this chart in a month for some reason, because it's been so kind of this hanging around down this level here, but this has bounced up to 117 now. I think a lot of the drilled uncompleted wells were kind of, the inventory came off, so I think they're just continuing to drill, not necessarily, remember, just because they're drilling the wells, they can cap them. It doesn't necessarily mean they have to have them come out, but they're just right there as inventory. It takes a good 4 to 6 months from drilling to actual production, at best. So they're just kind of maybe prepping, getting it going. It's kind of inventory there that's available, knowing that pricing will potentially go higher. So, but that's still interesting to see that. And with that is, again, production. This is something I like to talk about a lot. There's a lot more flexibility in production, and that's what they're drilling now. Maybe they're building out these, doing uncompleted wells, you're gonna cap them a little bit and have them ready to go so they can like ramp this up or down according to where the prices are at the time, and take that. It just gives a lot more optionality to the producers. So a lot more flexibility in this. But yeah, we're hitting up really high, decent production numbers, but it's not going off the charts. And again, it shouldn't, because there's enough gas right now, and there's enough to be feeding what we need. LNG exports, we see this chart pretty much every month, but then just want to remind you, this still is going on. I mean, this is current into 27, which is only a little over 2 years away. 27, that's 10 BCF of gas that we're gonna have to add, and the producers know that, just to keep pricing at these stable levels. And this is why we think those outer years are very good fundamental values right now. It's almost really an asymmetric trade. Asymmetric meaning there's not much risk. So, but there is risk if you're short. That's not an asymmetric trade. That's the other way, and which everyone is if you don't have the power, or you don't have power or gas in those periods. You are short the market. You're not neutral. You're not getting long by buying it. Annual peak load. Again, this is PJM. Really interesting here. I laugh at this 2025 number of 144. That's their projection. It's much higher than that. Because we've already hit 163, 164, and we have some, it's well over that where we've hit already on the peak load. So are these numbers going to continue? In the forecasts are going to get higher than that? I don't know. But here's the main thing, and this is really important to understand, because we get a lot of these questions about blackouts. Is there going to be blackouts and blackouts? PJM will not really allow it. They're not going to build out their system for that. So they're not going to just be handing out power to data centers left and right, and this load goes to 200 gigawatts or even the 183 here in 2020, 2030, unless there's generation that's also connected to the grid. There's a reserve margin they have to hit. They hit 18% in this latest auction. Relatively healthy number. That's not the lows by any means. I've seen numbers as low as 12, 13% before, but it's not as high as 24, 25% we had when prices were even lower. So on the capacity side, but this is it. I mean, this is where we're seeing this at. So with this will go. We'll have sufficient generation, hopefully, to cover that, cover this, and cover this. So the main thing is I think we're very bullish on, relatively bullish on capacity prices, so at least keeping the same kind of levels, more so than the power prices. Unfortunately, it's harder to hedge the capacity, although we do have some suppliers for larger customers that we can work some arrangements out. And some additional market insights. I'm not going to read through all these. These are, by the way, there's a PDF. And there's of course a link to Thrive in that one slide and a scans code. So PDF is right in the webinar stuff. You can see it there. So just go snag that, and also be sent out to you guys afterwards. But some of those things, I'll just read the headlines here. AI data center demand projections clash with chip supply reality. Headline here is if we hit the required power needs we have of data centers, it's going to take up 90% of global AI chip supply by 2030. So that may be a limiting factor in how much demand center growth gets built. Natural gas construction costs have surged 44% since 2021. Again, these are just some insights that we've gleaned, we like to put out there. We put these out in our weekly reports as well. We see them. They're kind of different news that you might not see out there if you're just watching CNBC or reading your local paper. Oops, there we are. Global LNG oversupply could pressure U.S. exports by 2030. This is something that we're researching. We've discussed this as well a little over a year ago. Could this be the black swan of where nobody's predicting that, really there could be a glut, and with a glut, and we build out all this production capabilities that that could really suppress prices. I'm not sure. It's not something to bank on, not something to manage your position around necessarily, but it's potential out there. And then U.S. nuclear biofaces fuel challenge, just unimported of really some of the supplies you need for nuclear fuel there, and the constraints that could be there as well for when we get in the mode of building these things out. And then here is the guest chart of the month. There's a lot of stuff here on this, so again, take the PDF, look at it more. The yellow line here, that's going to be the solar generation in PJM. This is June 23rd. This is the highest peak day. This is something that's happening everywhere. It's happening in ERCOT here. And here is so yellow line is the solar generation. That's in the yellow over here. And by the way, this chart is courtesy of Calpine. This is the PJM load, the blue and the blue, right? And here's the price peak. Here's the prices over here, right? So we're hitting around this $200 level, which relatively normal for a day. We're gonna hit 8 gigawatts above where PJM predicted the load for the year, and one of the hottest summer days we've had in a while. And here is so there's the price. The price peaked at 1,000, but it didn't peak on the load peak. It peaked on a couple hours later. And why is that? That's because that's when the solar generation comes down. So it's called a net load. And a net load is really kind of, you take out the renewable side of it because that's, relatively can be generated as well anyways, and it's zero cost to generate that stuff, right? So anyways, it's actually the price peak happened when this solar gen just starts really tanking down in the evening. So the price peak is now, the load peak is still around 6 o'clock, but the price peak is hitting more in the evening here. And this is an interesting shift that's been going on with this solar generation. But look at this solar, and this solar generation here is almost double what it was a year and a half ago. So, and it's going to continue to increase. But this is where batteries now come in, and this is where Texas has really done well on the battery side, and this is where you get the batteries to come in, and PJM is going to be bringing on more and more of these. This will smooth out this load, and batteries will come in and dispatch here, and it will kind of like smooth the edge solar plus battery will smooth this whole thing out here. So prices will come down lower. So that's the guest slide of the month. And let's go into just a couple plugs here. Again, Competitive Energy Box Market Research. Here's just some pieces that we put out. We have a weekly historical charts we put out, which you just saw earlier. We have a weekly energy market update with a lot of these same graphs and some insights and all that. And then we also occasionally have these market insights. The latest one was this energy squeezes coming from inside the system, a good piece that we put out, just really talking about, kind of the mismatch between energy demand, the capacity of the grid, supply chain, all that stuff, labor force, really interesting piece there. And I think that's it. So, all right. Glad I had my coffee this morning. Allie, I'll let you take it away here. What new energy policies mean for buyers? Take it away, Allie.
Awesome market update, Scott. Thank you. Loved all of the charts and all of the notes. Really interesting stuff considering what's going on. If you guys remember, if you were with us about 7 months ago, we did a little prediction just based on the outcome of our new federal election and the newest administration that was incoming. We did a little bit of a prediction, and we talked about what we thought were going to be some of the changes. We talked about some of the plans, some of the things that the new federal administration said that they would do. And we said, well, we're actually more than halfway through the year now. It is absolutely flying by. They've made some moves. Let's go ahead and take a temperature. So we're going to review our changes in U.S. energy policy, both nationally and statewide, and then we'll talk a little bit about what that means for energy buyers. So a lot of this you may have seen in headlines. New federal budget bill, the one big beautiful bill. The effects of that passing federally is that we are going to see some wind and solar tax credits phased out, unfortunately. Just like Scott was talking about, Texas has built out a lot of renewables, a lot of wind. We are going to need more renewables. We're going to need more generation assets. So unfortunately, these credits being phased out, that's going to make a lot of these projects, it's going to change the finances on a lot of these projects. It's just going to be more difficult to build out renewable generation. So these projects must start construction by June of 2026, so a little under a year from now, or be fully operational by December of 2027 to qualify for any of the credits. After 2027, no federal tax credits are going to be available for new renewable generation. And unfortunately, that means our projected renewable capacity additions were reduced by almost 60% through 2035. We're also seeing EV charging credits reduced and deferred methane fees. So deferred methane fees eliminates a little bit of a cost risk for natural gas producers, just means that they can go on about their business. That supports stable gas supply pricing. You'll notice a lot of Scott's market update and a lot of these pieces, it's actually looking really good for our domestic fuel supply. For natural gas, for oil, for all of these things that are kind of local domestic supply in fuel, all of that's looking really, really good, looking really strong. They are fast tracking, you can see the other federal actions, they are fast tracking oil, gas, LNG projects and nuclear projects, which is awesome. We do have some interior and EPA rollbacks, so that is just further deregulating. It's slowing renewable deployment. It is extending fossil plant life. It is knocking some of the rules out of place that we've had for a little bit, so we may be able to maintain a little bit more baseload generation just a little bit longer. And these federal rules do override state level clean energy rules. So with our new federal government kind of taking a more deregulated approach and rolling back some of these regulations, we may see some falling costs around that. Changes in state energy policy. We do have some change in Texas. We have a new mandate that requires wind and solar projects to have natural gas or battery backup. That adds a lot of complexity to the cost. Again, it's just going to be a little bit more difficult to get more expensive, less federally supported, less supported projects in place, especially when we are also making them more expensive by nature. Batteries do tend to be expensive. In New York, we have open support for gas transmission infrastructure amid the delays in the offshore wind development that was set to happen in that area. So this is good. It's improving stability for natural gas supply and pipelines. Again, this is a good thing for our domestic supply and for all of our natural gas producers. Illinois has passed a skinny clean jobs bill, which is awesome, expanding clean energy financing, initiating statewide energy storage feasibility. This is going to create new opportunities and support for renewable energy buyers. Remember, guys, that renewable energy does create jobs. Energy creates jobs. So with some of these renewable energy projects becoming a little bit more expensive, we may also see a little bit of local economic decline. Most states are reviewing their tariff laws to ensure that new loads, data centers, manufacturers share the cost of transmission system expansions, which is something that we desperately need nationwide. This is raising cost implications for large new energy buyers. So anybody who is setting up shop really needs to hook up with somebody who is able to give them some good intelligence and give them some gives them some insight as to what's going to happen over the next decade, because we should be seeing some pretty substantial changes, both based on some of Scott's charts and this. So how are energy buyers impacted? What can we, as people who are in this industry day in and day out, how can we help? What can we do? So on the natural gas side, like we were talking about, we have enhanced supply stability with increased federal and state support for infrastructure, pipelines. We're reducing our regulations. We're reducing our fines. So really just paving the way for us to have a really robust natural gas domestic supply. This is a really great federal regulatory landscape because we have state level openness to gas transmission expansion, like in New York, which is historically a state that can move a little bit slower whenever it comes to building out that type of infrastructure. And federal regulatory rollbacks, just making it easier to make moves. There is some potential upward pressure longer term that is just driven by higher demand and electricity moving more more into natural gas, setting more peaks. Scott was talking a lot about PJM setting new peaks. ERCOT is continuing to see that growth too. We're going to continue to see that growth nationwide, so that will continue to support prices and to put some upward pressure there. As far as electricity is concerned, this is the piece where I'm a little bit more concerned about it, just because we have domestic supply doesn't necessarily mean that we can domestic natural gas supply, and even if that is fairly priced, even if we absolutely max out our storage, that doesn't necessarily mean that power prices will go down, be less volatile. It doesn't necessarily mean that we aren't going to see load growth that will snap up all of the available supply, or that any of the physical infrastructure issues where we're needing some build out in order to smooth out, additional generation resources or additional transmission resources. Unfortunately, a robust domestic natural gas supply doesn't solve any of those issues. So the electricity piece is the more concerning piece, I think, at least to me. And Scott, feel free to comment once we're through it. But REC prices are expected to nearly double from current levels. Obviously, with renewable energy projects receiving less federal support, having more complicated financials behind them. For 2028 vintages and later, as less renewable generation is slated to come online, and as these projects are more expensive and more complicated, we will see pricing support for the renewable energy credits for renewable energy that is generating. We will see increased volatility, like we were talking about, just due to the rollback of renewable support. A lot of times renewables are what is coming in to fill any sort of generation gap. If we don't have the renewables there, or if they aren't building out those additional resources when and where they're needed, unfortunately, that support isn't going to be there. So we are going to continue to see those volatile price patterns like Scott was talking about on that last chart. We're also, unfortunately, going to see a lot higher grid integration and transmission costs passed on, particularly to large load customers, driven by state-level tariff reviews on transmission expansions. A lot of these larger customers, they're coming in, they're going to be great for local economies. They're going to provide jobs. They're obviously there to grow their businesses, but there are going to be significant costs associated with the amount of power that they take up, whether that power is available to them or whether it's something that they have to actually work with the local utility, with the state and with their county, with their area, to be able to support their operations in line with keeping the rest of the grid in balance. Remember, it's all about balance. So bottom line, guys, the last 6 months have marked big dramatic shifts in U.S. energy policy, some of the biggest in history. So while focusing on deregulation and accelerating nuclear and other generation sources, it's going to help. Long term, that is great news. But those projects can take 5 to 10 years to materialize. And in the near term, with some of the peak demand forecasts that we've been seeing, some of the load growth that is predicted, even if we do have that really nice, robust, even a supply glut on the natural gas side, it doesn't necessarily mean that we're going to see more stability on the power side. We are still going to be seeing this volatility, particularly if we phase out renewable incentives, so that those projects that are meant to kind of step in and fill that gap and just catch you for the few hours that you need some support. If those resources aren't there, then we will see significant spikes and increased volatility. So Scott, anything else on that? That's really kind of my view based on your market brief and everything that we're seeing. It's all really good news for production and for everybody in wholesale, everybody in upstream. It sounds like they can go about their business and do whatever it will make them the most money in the environment that they're in. But as far as all of us power buyers, I'm a little bit more concerned.
Yeah, exactly. And again, I'm going to emphasize, and I emphasize it all the time. What we try to do here is we look at ourselves really more as commodity risk managers, right? And we're not selling energy, and neither really is broker or a consultants we have. You're not selling energy to your clients. You're managing the risk. You're helping them manage that risk, right? And these are important things to bring up to them and add value to that that issue, right? And because this is not like it was 5-6 years ago where prices just stayed in that $30-$35 range throughout PGM and ERCOT, and like, yeah, okay, prices are $1 higher than the last contract, and I'll just wait a couple months, maybe it'll come in there, okay, and don't have to worry really about the upside. Yes, we think we're going to have some lows that come here. We think some areas are a little overpriced right now in some areas, but this is in the long term. We're on almost like really a train wreck in a way of and the electricity and the power side of really what's there and what's not. I mean, do we have the generation capability? Do we have the materials, the resources to build out the generation, right? And to get there. And in the meantime, you have all this demand that wants to come on in here, but they're not going to build this demand if there's not supply. But we need to get that. All of it's there. But at the end of the day, power is a commodity, and it's what's needed, and you can't just build up a big stockpile of it and store it, right? And it's like it's needed in real time. But really, in managing this position, you're short. Our clients are short the market because they have, and that's the position they need to manage. It's a very, very dangerous position to have, to be short the market, and especially short the market in something like this where we have all these potential fundamental things. So keep that in mind when talking to your customers. These changes in the law, personally, what troubles me a little bit is like, great, I love to see the deregulation. That's great. I love to see all this deregulation. I love to see that we have, we're building out some more pipelines for gas and like drilling for natural gas. I think these are good. Natural gas is a good. It's not super clean, but it's much cleaner than anything else. Great. Okay. Great. We're not burning oil here as much. I guess doing the New England sometimes in winter a little bit, but we're not burning oil. Coal has come off a little bit. I don't expect a big boom in coal. No one's going to build a new coal plant. Some of them are coming back online, or it's taking around a little bit longer, but we're not going to have a big build out. We're not building out more. And so in the meantime, if we're going to get to here, we need to incentivize all sorts of generation. We need to do nuclear. That's a long term. It's going to be 5-10 years. We need to do natural gas. Maybe incentivize natural gas, but a reduction tax credit on natural gas. It's great, but keep them for the renewables as well, because we need all power we can get, and it should not be politicized. We're very apolitical here, but it should not be. This whole energy policy is starting to be politicized, including the newest FERC commissioner that was put in board that is being nominated. It does not even have energy experience. It's very troubling to see that, and handing out political favors for that. So this is a serious issue. We take it seriously. I think the world's waking up to it, how serious an issue is. America's waking up to it, but we need to incentivize everything, and bring anything that can onto the grid, battery, solar, wind, we got enough of that, but natural gas, nuclear, bring them all on. Let's incentivize all these. So I'll get off my soapbox now. All right. And just want to let you guys know we're here to serve you. So we keep providing more. By the way, PGM alerts. Make sure you're getting these. There is a CP notification out for tomorrow and Friday potentially. We've nailed the highest 3 right now already, and on the 3 we've called out. We try to minimize the amount we send out, and we're really doing a good job of that. Trevor, who's part of our team here, has done a really good job building out the tools and algorithms for this, and really shout out to him. But that's one of the pieces we bring, because our customers, even if you save 10%, you achieve your load 10% on those 5 peak days, that can be $2 to $3 a megawatt hour. I mean, these customers fighting, I'm gonna wait, give me $2, my prices come down $2 more and I'll buy, right? Here's this simple way, and there's automations that can be put in place. Just discuss that with different vendors. Demand response, participate in that. These are ways to reduce these capacity cost increases, and just let us know. But we're here to serve you. We got market research We've got analytics. We're here to really deliver customers to you and bring this stuff, especially our team here on deals that are over like 3 million kilowatt hours and above. Bring us into the fold. We'll not only find a good strategy for the customer and get in a call if you allow us to join. We love the privilege to do that. We'll also figure out different sales strategies for you, how to win customers, right? And that's really big too, and be another person in the room to help you decide, help you make decisions and work on strategy. Kind of think of us as the chat GPT of energy, right? You use chat GPT, you throw some, hey, improve this sentence, improve this wording to the customer, this email I'm writing. We're here to help you be another sound mind and a different way of working on a strategy with the customer. So please utilize our team. Thank you guys, and looking forward to talking to you again sometime about 3 or 4 weeks. Enjoy the rest of your summer, all. Thank you.
Thanks, everybody.